isn't a whole lot to go on macro-wise this week, with perhaps the American housing starts number on Tuesday the 20th of November the main feature. As the US Federal Reserve gradually raises interest rates, with a fourth 0.25% increase of the year and a ninth of this upcycle expected at December's meeting, analysts and economists are looking for evidence of whether the tighter policy is starting to impact the US economy. Now, it's hard to think of a more interest rate sensitive sector than housing, and the US 30-year mortgage rate is creeping back towards 5% for the first time since very early 2011. Now, housing starts grew by 8% to 1.27 million units year on year in August, as we can see here. But the third line shows year on year growth in the 3-month moving average for housing starts, just to smooth out some of the monthly noise. As we can see, there's definitely been some kind of slowdown. Now, whether this is a blip or a trend remains to be seen, but American house building stocks are paying attention. This is the S&P Home Builders Index with 36 companies in it, ranging from builders like Lennar and D.R. Horton to white goods suppliers like Whirlpool. Doesn't look that great. Now, this is not to say the US economy is about to drop in a hole, but with housing maybe slowing and car sales already stalling, investors need to keep their wits about them. Yes, the US economy does look strong now, but everybody knows that, and any slowdown could therefore conceivably represent a negative surprise, even as the sugar rush brought by President Trump's tax cuts of last December begins to just wear off a little bit. Company-wise, 10 FTSE 100 firms and a good number of FTSE 250 members and small caps are scheduled to release results or trading updates in the coming week. They include Compass, CRH and Halma on Tuesday the 20th of November, Kingfisher, Sage and United Utilities on the 21st, and two more utilities, Severn Trent and British gas owners Centrica, on Thursday the 22nd. However, the company most capable of causing a fuss in the week ahead looks to be easyJet, when the airline releases full-year figures on Tuesday the 20th of November. The shares have had a torrid 2018, and as I sit here, they're trading about a third below their year highs after a second half nosedive. Concerns have included a strong oil price and its impact on the company's fuel bill, increased industry capacity and therefore competition and possibly price pressure, and losses suffered by easyJet on the routes offered out of Berlin's Tegel airport as the company tackles the German market, which has become very competitive, and also Brexit, where under EU law, UK-based airlines could, in theory, lose their licence to operate and access to Europe's Open Skies agreement if their shares are more than 50% owned by non-EU residents, which British residents would be. So this is all keeping Chief Executive Johan Lundgren busy as his first year in the job comes to a close. October's trading statement at least featured no additional bad news, as Mr. Lundgren steered full-year pre-tax profit expectations toward a range of 570 to 580 million. That compares to last year's 385 million, as we can see here. Besides that number, look for the dividend per share, which is expected to rise to around 54 pence, owing to the rebound in headline profits, as we can see in this graphic. But the real interest is likely to lie in the outlook statement, the forward-looking stuff for the year that's just begun. Analysts are currently looking for pre-tax profit to come in broadly flat at around 580 million, and the key moving parts to this are as follows. Capacity growth, where easyJet's previously targeted a 10% increase, with half of that coming from Berlin Tegel. Currencies, where easyJet expects a 10 million negative hit. And fuel, where costs are expected to rise by between 55 and 105 million pounds, a year-on-year increase of about 6%. We can see just how important fuel is to easyJet. At the first half stage, it represented 21% of total sales and 23% of total costs. Now, those numbers have actually been trending down thanks to oil's slump in 2015-16 and some forward hedging, but crude has gained ground in 2017 and 2018. It may be therefore of some comfort to Mr. Lundgren and easyJet shareholders that the oil price, as benchmarked by Brent crude, is now down almost 20% from its highs, back to around $70 a barrel. As we can see from this comparison of the year-on-year change in oil and easyJet shares in absolute terms, in the short term at least, crude can influence easyJet shares, although we must all acknowledge the past's no guarantee for the future. In crude terms, if you'll pardon the pun, a rising oil price does seem to weigh on easyJet shares, and a falling one does seem to help. Thank you for watching, and I look forward to seeing you next time.